Remember, the hardest part about investing is buying. When everybody else is selling, trying to step in and buy something is the most difficult thing to do as investors. Our emotions are working against us. Our fear dynamic is working against us. Everything tells us to just cut and run, just sell everything now. That typically turns out to be the worst actions that we can take. It's hard, right? Right now it's tough, absolutely tough. When you wake up in the morning and you see the Dow down 800 points and the S&P down, 100, 120 points. I mean, it's like, oh my God, that's that emotional bias kicking in. That's where we feel like, oh, I've got to do something. But sometimes doing something now is a little too late.
You're listening to The Real Investment Show.
I posted this article this morning called, the market crash, kind of hope and the fear. And just kind of going through some of the data. So again, if you'll bear with me, I want to kind of lay out a kind of the premise of what's going on in the markets. And the thing I want to try to get to here is, again, I don't care what you do with your own personal portfolio. That doesn't matter. I'm just trying to figure this out just like everybody else is, right? What is the magnitude of this? How far does it go? What are the correction? What does this mean? Recession, non-recession, those type of things. Lots of people run around it's like, oh, it's stagflation or it's this or it's, it's going to be a massive recession. Nobody knows anything, right? We can make some assumptions, and then based on those assumptions, we can come up with a better portfolio strategy. And that's kind of the whole goal of this article kind of this morning. But so one of the things that we know for a fact is that earnings are going to track economic growth. And there's, a very high correlation historically between earnings growth and economic growth because earnings come from economic activity. So if you really want to know where earnings are going, you just have to figure out where the economy is going. So if you're in the massive recession camp because of tariffs, whatever the reason is, then you should expect dramatically lower earnings. If you are in the non-recession camp, then you can expect a better rate of earnings growth, albeit it might be slower than what was originally anticipated because of tariffs, right? So just, again, this is where you've got to make your own decisions about your assumptions. And again, it's this is the same as going to playing, kind of playing blackjack and Vegas, and we're all betting on possibilities versus probabilities, right? That's what this all comes down to. But this is a chart showing you the annual growth of earnings versus the economy. And so you see the red dot, that was 2024, where we had economic growth that was running, kind of well above almost 3%. And you had earnings growth that was up about 9% for the year. 2025, on current assumptions, we're going to have earnings growth somewhere around, GDP growth somewhere around 1% this year so far. I think at least what's expected right now. And we can take a look at earnings growth is about 3% at the moment. Now, this is based on kind of current estimates. Okay. So having said that, that's what you can kind of expect for this year looking at that. But let's make some assumptions on tariffs because, again, this is what we're trying to get to is what does this mean for earnings? So let's assume that we have negative earnings growth, negative GDP growth this year, right? So we're going to have a negative 1% GDP growth. That's a fairly decent recession. It's not, depression era type, but 1.5% negative GDP growth rate is good. That's a decently deep recession in the economy. Contraction in spending, rising job losses. You're going to get unemployment running around 5, 6, 7%. You're going to get the decline in inflation because of less economic activity. So it's a fairly decent recession. So if you look at a negative 1% growth, you're going to have earnings growth falling, fairly well. You're going to have negative earnings growth 1, 2, 3% as well. So that kind of shifts that whole 2025 forecast way off to the left. Now, those big outliers that you can see on the graph, the 2008 financial crisis, the 2020 pandemic, the 2021 pandemic stimulus surge, when we send in the stimuluses, those are the one-off events generally generated by some type of exogenous event like coming in with a massive TARP QE package like we did in 2009, or coming in, shutting down the economy and having the 2020 pandemic breakdown where you just collapse the economy. Those things happen, right? But they don't happen often, and generally the outliers are the recovery periods, not the actual decline period, right? So again, it's where earnings are really beginning to recover strongly coming out of a period. So, but again, you kind of get the idea that, if we want to know where earnings are going to go to, we can take some pretty good assumptions. Now, since the beginning of this year, I've been talking about earnings estimates being way too elevated, that Wall Street's expectations for earnings growth was way too high, and that would have to come down. And we didn't, and as we said then, we don't know what will cause that, but something will occur and these estimates will have to come down. Well, we now know what it is. It's now tariffs. And those estimates are now declining. And what we had said previously is that we'd have to get to $220 a share to get earnings back to their long-term economic growth trend line. And it was interesting because Goldman Sachs just came out with a chart and said, okay, in our recession scenario for earnings, $220 a share. So there you go. Right? We wrote about this a month and a half ago. Goldman Sachs now catching up with us. We appreciate you, Goldman. But we can take that $220 a share and we can actually do some work with that. And we can figure out kind of where the markets are. So this is what we're looking at. How do you price a market? You price markets on valuations. So if you want to know where the stock market is going to trade over the next year, pick an earnings growth or pick an earnings level. In this case, we're going to use $220 a share. We're going to use that recession scenario put out by Goldman, $220 a share. And we're going to say, based on that, let me back this up. Let me start with the positive scenario first. So we'll take out, before we get to the recession scenario, we'll talk about what the expected scenario is that right now expectations are $253 a share in earnings. So put a multiple on that, right? So we put a multiple on $253 a share in earnings, and you say, okay, I think the market will trade at 22 times earnings, 20 times earnings, 18 times earnings, 16 times earnings. So based on that view, right, I can now come up with a price of the market. So just like you do valuations, I say price divided by earnings. If I do earnings time price, I can get the price of the market based on expected earnings. Where we're currently trading is about 20, as we closed on Friday, we're trading at 20 times those forward earnings. So if we can get to $253 a share, now that's down sharply from $296, by the way. So 253 is still kind of a very reduced earnings expectation going through the course of this year, down sharply from where they were previously because of these tariffs. So we're currently pricing in about 20 times earnings right now. 18 times earnings gets you down, to kind of where, the markets are going to start finding support from the 2022 peak as we entered the market then. And then if you get down to 16 times earnings, you're looking at, kind of taking out you'll take out all of the gains for the most part, since the October 2022 lows. So there is some downside risk here based on these reduced earnings. But again, you can take any number you think. You can take the S&P 500 and say, I think earnings are going to trade at 220, 250, 230, whatever that is. Reverse that into a price by picking the valuation. I think earnings should trade at this type of a valuation. Now, historically, markets for the last 35 years have traded in a range between about 17 and 19 times earnings at their lows. So using kind of that multiple, you can start backing into where you think the market will trade. So again, bullish, bearish, whatever it is, doesn't matter. That's how you get there. But markets aren't going to go down to that level directly. We're not going to go there in a straight line, although it seems like it over the last few days. And again, we haven't seen a decline in the markets like we're seeing now since the pandemic. And there's a difference, right? We do have tariffs this time, which are being implemented, and that's certainly concerning. right? But we didn't shut down the entire economy. You remember back in 2020, we literally shut down the economy. There was no economic activity. We have economic activity going on. We're just applying a tax to that activity. So it's a very different environment than we had back in 2020, yet the markets are dropping like we've now just shut down the economy. So maybe potentially a bit of overreaction here. And this was where some of the technicals really kind of jumped out to me over the weekend. This is our technical composite. This is a weekly average of about 13 different technical indicators that, deviation from markets, momentum, relative strength, etc., all combined into one indicator. That dropped to 7 on Friday. We were at 708, was it 771 to be specific, on Friday. We were at 708 at the bottom of the pandemic, right? 647 going back, in the 2018, crash when the Fed was hiking rates and we were having kind of panic over that. So we're at levels that are normally associated with deep sell-offs in markets. The only other times they were lower than this, and again, you have to make the case that we're now in a dot-com crash or a financial crisis, was those two periods. We got down to 1 or 2. But we're not far off those levels. Another week of, it might even be there today if the market opens down. But in an environment where you have that type of technical destruction, markets typically start trying to find a bottom. So again, we've got some more data to go through when we come back, but just be a little bit careful with the fear in the markets. And when we come back, we'll finish this up and talk about what we're kind of the next actions for portfolios that we'll take based on some of this data. Don't go away.
You're listening to The Real Investment Show.
If you don't watch basketball like we don't watch basketball, I'm not a big basketball phenom myself. We don't ever watch a basketball game in our house, ever. We watched about 30 minutes of Duke and Houston playing, and they were leading by 14, 15 points. We said, they got this wrapped up. We went to bed. And, of course, the next morning, Brent posted wanted to rub it in this morning. So Brent posted a picture on my notes page that says, Duke led by 14 with 8 minutes left. Duke led by 9 with 2 minutes left. Duke led by 6 with 34 seconds left. Duke led by 3 with 25 seconds left. Duke led by 1 with 19 seconds left. Duke lost. And that's true. There's actually an important point to that, which is this goes to investing as well. And something that I'm talking, and this feeds into our conversation this morning, by the way, is that this is the trick with investing, is going in to that game between Duke and Houston. Duke was heavily favored to win. I mean, it was pretty much a lockout that Duke was going to win this game. And it didn't happen. Unexpected things can happen. We talk about this about portfolio management all the time, is that the thing that we think is going to happen sometimes doesn't. And when it comes to investing, the things that we're banking on happening often don't. And that's kind of where we are. I'm just reading some of the comments in the YouTube chat this morning. And, there's a lot of really bearish stuff here. And that's okay. There's nothing wrong with that. But just be careful to not be too bearish. Again, our job as investors is to be eagles, which is just look at the landscape, survey from, 300 feet in the air, and pick your targets. And don't get too wrapped up in being just bullish or just bearish, because things are going to change. And they're going to change very rapidly, like on a dime. And markets will start making new assumptions. You remember this back from 2022 as a good example. Markets were declining because the Fed was hiking rates, but then we started, the markets would start, but maybe they're going to start, maybe they'll stop hiking rates here. Maybe they'll stop, and the markets would get this very big rally, and then the Fed would come out and say, no, we're going to keep hiking rates, and the market would sell off again. And as soon as the market sold off, the market goes, but maybe they're going to stop hiking rates, and then the markets would rally again, and then the Fed would kind of crush those hopes. And we kept having these rallies and declines during all of 2022. And that's still probably going to be the case with what's going on with these tariffs, is that markets get super negative. They're going to start finding a narrative. Markets want to make money. Wall Street wants to make money, right? So they're going to find a narrative, and they're going to start buying stocks somewhere in here at these lows and run these markets back up. And then you're going to get really bullish on stocks, and then that's about the time they're going to start selling again, and you're going to retest lows and those type of things. So we're going to go through this for a while. This volatility rise is going to be with us for some time. And so our job here is going to be try to pick our targets where we have some opportunities. And don't be overly bullish. Don't be overly bearish. Just navigate the landscape. Let me show you a couple of. So I showed you that technical chart down at 7. That doesn't happen very often in history. And when it does happen, you're typically near market lows. Same thing with our fear-greed gauge. Now, our fear-greed gauge is different than, people go, well, why is yours different than CNN? Because we measure different things. CNN uses the S&P index to measure the S&P index. Seems kind of ridiculous to me, but okay. So this just simply measures how people are allocated. Sentiment and allocation, right? So this is bullish sentiment versus bearish sentiment. It's asset allocation. It's the volatility index. It's all those things kind of all rolled into one composite index. It's now at 30. And that's it's not extremely low. It's not as low as we saw it back in the pandemic crash. It's not quite as low as we saw it during 2022. It's not quite as low as we saw it during the dot-com crash. But it's very low relative to history, and is at levels that normally markets find corrective bottoms. Again, no guarantees of anything. But as I was kind of using that example of blackjack earlier, but same thing with Duke versus Houston, right? We bet probabilities versus possibilities when we're betting, right? Gambling. The probabilities were that Duke was going to win. They didn't, right? That's the possibility overrode the probability. And I wrote about this in the article talking about playing blackjack. If you've played the game of blackjack, if you're dealt 20, 10 and an 8, right? You're holding 20. I'm sorry, 10 and 8. That's 18. you're dealt an. I get my math right this morning. You're dealt an ace and a 9, so you're holding 20, right? You're going to hold that hand. You're not going to take another card, because if you get anything other than an ace, which could count as 1 or 11, you're going to bust 21 and you lose. So you're going to hold 20. The dealer has to get 21 without busting to beat you, or 20 at least to give you a push. You just get your money back. The odds of getting 21 is very difficult without busting, but it happens. I've played before, and I'm sitting with 20 as a good example, and they dealt themselves a blackjack, right? It happens. But that's a possibility versus a probability. So as investors, what our job is to take a look at this data and say, historically speaking, we are at levels where the probabilities versus the possibilities are in our favor. But does that mean the possibilities can't still win out? Yes, they can. But this is where we've got to navigate, right? And at some point, you've got to start making some decisions about your portfolio. Let me show you this chart. This is our risk range report. We published, by the way, all of these charts, they're in the weekly newsletter. So if you don't subscribe to our weekly newsletter, either at Substack, at Lance Roberts on Substack, or on our website, realinvestmentadvice.com, I email it to you every weekend when we publish it. But all these charts I publish every week in the newsletter for you, along with a lot of other stuff. Relative rotation, stock screens, whole bunch of stuff is in the weekly newsletter for you to help you manage your money better. But what this table shows you is, and I want you to focus on these far right columns, is when markets are oversold relative to their normal ranges. So based on every sector and market, they trade within a normal range in a given month. So if things trade, you're having a lot of buying going into something in a given month, it's going to be it's going to be on the top of its risk range. Normally when that happens, you get a reversal. When things trade well below their risk ranges, you get a reversal in the other direction. You'll notice that the vast majority outside of gold and gold miners, which are still extremely deviated from the long-term means, most markets and sectors are trading well below their long-term averages and well outside their normal risk ranges. When you get this type of deviation, markets are generally near lows. Probabilities versus possibilities. Does that mean these can't go lower? No, but you're at levels, technically speaking, market speaking, that normally markets start finding buyers. Remember, buyers are sitting out there. We've talked about buyers live lower, sellers live higher. Well, we saw the sellers, right, come into the markets, and buyers were going, yep, I'm here to buy down at these levels. And at some point, buyers are going to go, hey, I'm stepping in. I need that chart for one more second. The last column is the number of bearish crossovers that currently exist in the markets. You have an exorbitant amount of those now in bearish crossovers, which tells us two things. One, when the number of bearish crossovers, kind of rise all at once as they did, you're normally near a short-term low, but you're not at the low. It is very possible we are now going to enter a longer period of market turmoil, as we've been talking about, where you're going to get counter-trend rallies and declines. So this is going to have to be part of what we navigate here over the course of the next few months as we kind of go through this. But when we come back from the break, I want to kind of lay out what we expect the market to do near term and what we're going to be doing in our portfolios based on those expectations of a more volatile market for the rest of this year.
You're listening to The Real Investment Show.
So again, what we've got to start looking at here, as we were talking about, is talking more about probabilities versus possibilities. And again, we don't know which one ultimately wins out. Possibilities can sometimes overrule the probabilities. It happens historically in markets, but not often. But it does happen. So we do have to be cautious with actions, but we have to take some reasonable actions, or at least some, prepare a reasonable battle plan, right, for what's happening in the markets and how to navigate them as we kind of move forward this year. So, if we kind of take a look at where markets are trading now, this was as of Friday. So this morning, at least, we're going to violate this uptrend line in the markets. But again, we should expect here, with markets as deeply oversold as they are on multiple levels, that we're going to get a reflexive rally here at some point, just simply from buyers starting to find some piece of good news or start to think about, Fed interventions, whatever they are, or maybe we even get the Fed to step in, or maybe something happens with the negotiations. Maybe China comes to the table. Any piece of good news, whatever it is going to cause a very sharp initial reaction to the markets. That's about all you're going to get. You're going to get this initial bump in the markets as buyers step in. And again, sellers have pretty much been exhausted at this point. So you're going to get people stepping back into the markets at some point. Whatever triggers that, who knows, could be a comment from the White House. It could be, again, a negotiation issue. It could be the Fed. It could be a variety of instances. It could be the market just beginning to say, hey, I think we've priced in enough, and buyers step in. But whatever causes it, you're going to get a reflexive rally in the markets. You always do. Especially when you have the sell-off as sharp and as of the magnitude that we're currently seeing. And again, when we go back to looking at all the different indicators that we went through today, again, all these charts, if you're driving to work this morning, all these charts are in today's blog post. It's on the website. It's called The Market Crash, Hope and the Fear. It's on the website right now. We're going to paste this whole thing into a video, put this online as well. This is at our Substack, so go subscribe to our Substack channel at Lance Roberts or on our website, realinvestmentadvice.com, however you want to get it. It's all there for you, so you can just go through this yourself, all the analysis in this. But we've kind of laid out what our primary focus is and what our process is going to be on whatever rally that we get. So the first thing we'll do on a rally is begin to reduce position sizing by 1/4 to 1/2% of the position, right? So if we're long 1% of a particular stock, we'll reduce that to 0.75% on the rally, but whatever it is. Kind of just rebalancing and raising a bit of cash, right? Because again, whatever rally we get, we're going to most likely have a subsequent decline. Now, if we don't, and the market just keeps going up, well, it's easy just to add stuff back in at that point. Once we start getting a lot of positive indicators, bullish indicators turn back up online, those type of things, easy to add money back in. But use the rally to reduce some risk, raise some cash in your portfolios, because most likely, probabilities versus possibilities, we're going to have a secondary decline. A lot of trap longs in the markets. They want to get out. So when the market rises, those sellers are going to come back into the market. And so you're going to get more selling pressure. So increase some cash levels, raise your stop losses in positions to wherever you want them. Sell positions that have violated kind of technical, structures and on a long-term basis. Now, this is where I would look at monthly charts versus daily. Does a stock that you own, has it violated long-term monthly trends? Probably not, but some have. And so maybe those are the ones that you just let go entirely for right now. There's going to be positions you want to buy that have been really beaten up, still a value, right? Have dividends, etc. Maybe some buying to do in the portfolio to get, again, just what you want to do, a rebalance in your portfolio in this rally. Longer term, following those actions, we're going to have, again, probabilities are we'll have a secondary decline, and at some point we're going to form a bottom to the market somewhere, either at recent lows, maybe new lows, but somewhere probably around this area, somewhere between 4,500 and 5,000, somewhere in there. We're going to form a more lasting long-term bottom. Now, at that point, depending on how fast we get there, what the devastation is, those type of things, we're going to then shift fixed income allocations. We'll sell long-term treasuries, buy corporates, look for broken convertibles, maybe even look at distressed high yield, those type of things. Because again, once the market begins to bottom, treasuries will most likely have the majority of their value priced into them. And so we'll want to start looking for underpriced fixed income at that point. Shift the remaining allocations that we have. So you got a lot of cash at that point, you've raised some cash, you've got higher cash levels. We want to start buying back into equities that have good long-term intrinsic value but have earnings growth. Because again, coming out of this cycle, whatever it is, we're going to start to see a return of earnings estimates going back up. So earnings growth will be very important. So companies that have strong earnings growth, dividends, value from the sell-off. They don't necessarily have to pay a dividend. It's okay to buy growth stocks as long as you've gotten some reasonable valuations out of those. So again, you go look at an NVIDIA or something like that trades at a peg of probably at that point close to 1. Something to consider on the growth side. Value stocks will still be value stocks. You'll want to overweight at that point, overweight equities versus fixed income. So our 60-40 allocation will shift to 70-30-ish. Now, when we get there, I have no idea. But that's kind of the roadmap of what we're looking. So near term, you get a rally, rebalance risk, raise some cash, get a little bit protective. But longer term, we're going to find a bottom somewhere. Now, again, a lot of this depends on, do we get a recession or not? And again, that bottom's not going to be next month. We're talking about later this year or even early next year before we get there. But it'll depend on recession or not, earnings levels? Have earnings estimates begun to stabilize at lower levels? Have earnings estimates by companies began to stabilize, right? We're going to see reductions in forward outlooks, those type of things, all related to tariffs. This is going to impact earnings, whatever it is. But once you begin to see those earnings stabilize, the markets are going to start finding a bottom. But again, it's not going to be next week and it's not going to be next month, which is why initially expect a rally, rebalance risk, get a little bit protective. Market comes down, tests lows, resets lows as we kind of go through. And that process, that secondary process will be the recognition of recession or not. If it's a recession, it'll be a deeper decline. If there's no recession in sight, just slower economic growth, the secondary decline won't be as deep. Now, the one thing that could derail all that is the Fed steps in, goes back to QE, cuts rates drastically, fuels the market. At that point, you got to make a shift pretty quick. But outside of an event like that, most likely rally, decline, set a bottom at some point. Again, it's not going to be a pretty process. It wasn't in 2022, but that process eventually ended, that corrective process. So that's what you want to be looking for. Again, how we get there could be ugly, could be multiple rallies and declines. It could be a variety of patterns the way it plays out. That's why we have to just navigate the technicals. But it will get there eventually. And what we've got to be able to do at that point is to step in and buy. Remember, the hardest part about investing is buying. When everybody else is selling, trying to step in and buy something is the most difficult thing to do as investors. Our emotions are working against us. Our fear dynamic is working against us. Everything tells us to just cut and run, just sell everything now. That typically turns out to be the worst actions that we can take. It's hard, right? Right now it's tough, absolutely tough, right? When you wake up in the morning and you see the Dow down 800 points and the S&P down, 120 points, I mean, it's like, oh my God. It's tough, right? That's that emotional bias kicking in. That's where we feel like, oh, I've got to do something. But sometimes doing something now is a little too late, right? There's sometimes we just have to hold on, suffer our way through it, and then fix things on the rally. But again, where's the bottom? Is it today? Is it tomorrow? Is it the day after tomorrow? Is it the day after that? I don't know. I don't know where the bottom is. I do know that technically speaking, the markets are telling us we're close to a bottom. Something is going to happen to trigger a buying response. What that will be, I have no idea. We can all guess at it. But the important lesson here is we have to measure probabilities versus possibilities and trade that as best we can. I know it's tough, right? We're here for you. We're going to walk through this every day, navigate our way through this. We're going to have some right calls here. We're going to have some wrong calls here. But we'll work our way through it. So just hang with us. Tune in tomorrow. We'll update you on where we are, and we'll just navigate this as we go. We appreciate you. Appreciate you viewing. Appreciate you watching. Please like and subscribe to the channel. Tell your friends. And be safe today. Don't make any mistakes. And we'll pick it up again tomorrow. Have a great day.